Investing and stock investing in particular is inherently risky. So, in the face of the risk involved in investing, should we get discouraged? The answer is no. One should not get discouraged. Forget about stories of people that lost money in the market. Well, sustained losses in the market is somewhat inevitable, but all the same, there are methods we could put in place to mitigate or minimize the risk that is inherent in the market. And so one of these strategies is diversification. You could use this particular strategy to minimize your risk exposure or exposure to risk in the market. So diversification strategies are essential for managing risk and improving the potential for long-term investment growth. As diversifying your portfolio involve spreading investment across different asset classes, across different sectors and geographic regions. It is designed to reduce the impact of a single underperforming assets in the overall portfolio. And so here are some key diversification strategies you could adopt to mitigate or reduce risk as an investor. Please subscribe to this channel and like this video if you've not done that. Number one is asset class diversification. You could choose to diversify across different asset classes. So in this case, you may consider stocks, bonds, commodities, real estate, and even cash. All right. So in the case of stocks, you can mix growth and value stocks across different industries or sectors. When you consider bonds, you could include government bonds, municipal bonds, as well as corporate bonds. If you want to bring in commodities into your portfolio as a means of diversification, this could serve as a hedge against inflation with assets like gold, or crude oil. Another, asset class you could consider is real estate. You may add property directly into your portfolio. You may choose to use REITs, that's a real estate investment trust. You could also maintain liquidity with cash or money market fund. So by so doing, you are adequately diversified across different asset classes. You may also choose sector diversification. In this case, you spread across different sectors or different industries. You may invest in the technology area. You may also include, healthcare, consumer goods, the petroleum sector, the banking sector, the industrial goods sector, as the case may be. So you diversify across different sectors, the market. You may choose cyclical versus some defensive stocks. So in this case, you balance between sectors that perform well in different market conditions. Some sectors could be overly exposed to economic downturn, while some other sectors may not be. All right, so you diversify across different sectors so as to mitigate risk. Number 3 is geographic diversification. In this context, you may consider, domestic and international stocks. You may choose to invest both in the Nigerian markets and in the US market as well. You could consider other countries. You may invest in European stocks. With the proper apps in your phone, you can diversify across different countries. You can invest in Nigeria, and you can as well invest in other countries abroad. And not only that, you may also consider emerging markets. Nigeria is a typical emerging market. So, in this case, you can, add high growth potential, with emerging market exposure. All right. Emerging markets are markets that just emerging, coming up newly, unlike, advanced, countries like the US or, some other European countries. You may choose to, invest in emerging economy. Nigeria is a typical example. And other African countries as well are typical examples of emerging markets. Number 4 is company size diversification. Company size diversification. So you may choose to invest in large cap and small cap stocks. You may have a balance between large stable companies and high growth small companies. So these are very important, crucial means of diversification. You may also consider growth versus value. So you could have a mix of, growth and value stocks in your portfolio. All right. And so the value stocks will give you dividends, and the growth stocks will give you, capital gain, appreciation in your portfolio. And then number 5 is time horizon diversification. Time horizon diversification. In this context, you have short-term versus long-term, investment strategy. So you combine liquid, short-term assets with long-term investments. You also consider, bond laddering. Bond laddering. So in this case, you stagger bonds, you stagger bond maturities to manage, interest rate risk. So bond, laddering here means that particular combination of long-term bonds and short-term bonds. So you can earn your interest at different intervals. You may have bonds that matures in months, bonds that matures in few years, and bonds that matures, over a long period of time. By the time you invest, you spread your asset, you spread your investment across these different maturities. You obtain what is called bond laddering. So you have interest coming in, your coupon coming in at different intervals, different length of time. Number 6 is investment style diversification. Investment style diversification. So in this context, you may choose active versus passive investments. Active versus passive, strategy. So in this case, you blend actively managed funds with passively managed index funds. You can invest in mutual funds that are actively managed, and as well as invest in other mutual funds that are like index kind of investing. They're not passively managed. And so not only that, you have direct investments versus funds. You may choose to invest directly by yourself, or you may also choose to invest through mutual funds or ETFs, that's exchange traded funds. These are very important means of diversification. Number 7 is diversification across investment vehicles. Diversification across different investment vehicles. In this case, you may consider stocks and ETFs. All right, so you can use ETFs, that's exchange traded funds, and mutual funds for broader exposure to different, various kinds of assets. And you may also, consider alternative investments. Hedge funds and private equity, can provide returns outside the traditional stock market. Although these are for, sophisticated, very rich investors, you may consider hedge funds as well as private equity investments. Number 8 is is dividend versus growth investing. It's a very important form of diversification. You may invest, in dividends, yielding stocks. You allocate to income generating, for stability. You may also invest in growth stocks. You invest in high growth opportunities for long-term capital appreciation. These are key components of dividend versus growth investing, kind of diversification strategy. Not only that, you have number 9 here is risk tolerance diversification. Risk tolerance diversification. So in this case, you have risk adjusted diversification. You adjust your portfolio to match risk tolerance. Balancing high risk and low risk asset. So you could go for stocks. It's a high risk asset. You can equally include bonds, which is a low risk asset. In a given percentage, in a given ratio, maybe let's say 60% stocks and 40% bonds, or 40% bonds and 60% stocks, depending on the condition of the stock market. And then you have rebalancing in your regular rebalancing. So in this case, you keep the portfolio aligned with your risk profile and market condition. All right. If the stock market becomes too risky, you can increase your bond part of the portfolio. And then if the stock market becomes less risky, you could increase the stock part, the stock portion of your portfolio. Then number 10 is thematic diversification. Thematic diversification. In this case, you may consider thematic funds. Invest in growing sectors like ESG. That's environmental, social, and governance. You can invest in technology sector as well as renewable energy. That's a kind of you can invest in these sectors through thematic funds that invest based on these themes I've just mentioned. You have global trends, so diversify into themes like artificial intelligence or aging populations. And so you tend to benefit from diversification because it helps you to reduce risk. And not only that, it smoothing your returns, and as well as protect against volatility. There is risk reduction, it smoothens your returns, and as well as help you to mitigate your risk. So it's very important we diversify our portfolio so as to maximize our returns, our investment returns at the end of the day. So please keep on watching my videos. You would end up becoming a knowledgeable investor at the end of the day. And the more you know, the more you grow, the more you learn, the more you earn.